evening, everyone, and thank you for joining us for Hindustan Zinc fourth quarter 2019 results call. For our call today, we have with us Mr. Sunil Duggal, our CEO, and Mr. Swayam Saurabh, our acting CFO. Mr. Duggal will present an update on business performance, and Mr. Swayam will take you through our financial performance, after which we'll be happy to take your questions. Over to you, Mr. Duggal.
Thank you, Preeti, and a warm welcome to all of you. We have delivered a good set of operating numbers in the fourth quarter despite a challenging start of the quarter. At the same time, we achieved few important milestones during the quarter. While silver production was strong, every quarter in the last financial year, our numbers in the four quarters were the best ever, again at 191 tons. At 679 tons for the year, we are now 9th largest silver producer in the world, one notch up from last year, and the fastest growing silver company. With our plant ramp up, we expect to be among top 5 global silver producers in the next 2 years. We expect to touch 1.2 million ton run rate as we complete our ongoing mining expansion in the middle of this year, a feat we achieved momentarily in the month of March last year, showcasing the preparedness of our mines. This expansion was started in 2013, as you know, when our underground mining capacity was 300 KT per annum. And once it gets completed, our underground capacity will quadruple to 1.2 million ton per annum. We started conducting sustainability studies at our tailing dams in fiscal 2018 in consultation with leading global experts to reassess the structural integrity and have covered Rampura Gucha, Rajpura Dariba and Zawar mines so far. In the light of recent high-impact failures of tailing dams in Brazil, as a proactive measure, we have decided to build all our future tailing dams as dry tailing to de-risk from dam failures. This will also conserve water and land requirement. The first such dry tailing plant will be completed in Zawar during next quarter. I am pleased to inform that we have received environment clearance to increase silver production at Pantnagar from 600 tons to 800 tons. We have returned significant cash to shareholders during the year in the form of a special interim dividend of rupees 20 per share in November last year, which is a dividend yield of over 7%. Considering this special dividend, the board has not proposed a final dividend for the year. To give you a market update now, zinc market supplies continue to remain very tight. Zinc price increased steadily throughout the quarter as LME inventories continue to be drawn down to historically low levels. Reported zinc exchange stocks are now estimated at 2 to 3 days of global consumption, which is much below the average of about 25 days. During the quarter, major floods were observed in Australia, disrupting zinc supply chain in the region. High-profile mining projects have had slow ramp-up than expected, and supply fill-in has not been there, limiting the availability of the metal. Consumption remains positive in China, with increased focus on zinc-intensive sectors like infrastructure and construction and huge demand from the One Road, One Belt project, as well as zinc-intensive industries in emerging markets. With this background, we believe LME is expected to remain above $3,000 level in the coming months. Now, turning to our operating performance, we continue to report excellent progress in our mining projects, with MIC production from underground mines increasing by 24% YOY to 245 KT during the quarter and growing by 29% to 936 KT for the year. It is gratifying to see Rampura Gucha operate at 4 million ton per annum run rate during the quarter, up from 3 million ton per annum a year ago, delivering about 60% higher production for the year. Sindeswar Khurd mine was at run rate of 5.6 million ton per annum as compared to 5 million ton a year ago. I am pleased to inform that Rajpura Dariba has crossed 1 million ton of annual production for the first time in its history, and the mine operated at 1.3 million ton per annum run rate during the quarter. Both SK and RD mine achieved close to 20% higher ore production this year. Zawar mine is operating at about 3 million ton per annum run rate, and for the year, it has delivered over 30% higher production. Kayad, on the other hand, has been operating at its rated capacity of 1.2 million ton per annum for 2 years now. As I mentioned earlier, we had a challenging start of the quarter when we faced geotechnical issues that resulted in lower mine output in January and February, but we saw improvement in March and production rose sharply to exit at a run rate of 1.2 million ton per annum. Despite these challenges, our MIC production in Q4 was maintained compared to the previous quarter. However, we missed our annual guidance on MIC by a whisker. This year, our entire production came from underground mines, as you know, unlike last year when we operated via open cast operation also for the entire year. So while we have ramped up our underground mines over the course of the year to the current quarterly run rate of about 1 million ton, our total MIC production for the quarter and the year were marginally lower by 4 and 1% respectively from a year ago. We have set new records for integrated lead and silver production in this year. During the year, we took a conscious decision to retrofit the pyro smelter to produce more lead, considering the higher availability of lead MIC and increasing lead content in the ore. As a result, lead production increased by 18% to a record of 198 KT for the year. Silver, which is a byproduct of lead, also increased by 22% to a record 679 tons, supported by better grades and was in line with guidance provided at the beginning of the year. The total integrated metal production for the year was lower by 7% to 894 KT, in line with MIC availability as underground mine ramped up to fill the vacuum from planned closure of open cast operation. While lead production rose, zinc production declined by 12% YOY to 696 KT. Integrated metal production during the quarter showed similar trend and was 6% lower sequentially and 15% lower from a year ago. Now an update on the progress of our expansion project. During the quarter, we commissioned the much-awaited crusher and production shaft at Qtr4 mine, which is presently used for hauling waste and will be used for hauling from the month of June. The mine achieved its highest ever total mine development of 5.1 km during the quarter. We expect to achieve our target production of 6 million tons this year with the commissioning of shaft and ongoing mine development. Rampura Gucha underground mine achieved a record total development of 7.3 km during the quarter. Production shaft along with crusher and conveyor system are expected to commission in September this year. The ramp-up of mine to 4.5 million ton per annum will be as planned, and we will continue to produce from decline and mid-shaft loading system in the meantime. We commissioned the second paste fill plant at Rampura Gucha ahead of schedule, and now the mine is self-sufficient in paste fill to support ore production capacity. We'll be commissioning the second paste fill plant at Hindustan in the current quarter, which will make this mine also self-sufficient to support the mine capacity. These paste fill plants are not only technically superior to fill voids in underground mine, but also environment friendly, as we use mining waste to fill voids which otherwise would need to be stored in tailing dams. With this, we'll be sustainably using 60% of our tailings for void filling. Zawar achieved total mine production of 8.6 km, which is 15% higher from a year ago. We have also commissioned a new 2 million ton per annum mill at Zawar during the quarter. The paste fill plant at Zawar mines, which is expected to commission by middle of this financial year, will significantly increase the potential of doing pillar mining and recovering the left out high grade ore in those pillars, thus having high impact given relatively lower grade of the ore. At Rajpura Dariba mine, total mine development continues to increase rapidly and was at 2.1 km. We are also upgrading the existing production shaft from 0.7 to 1.3 million ton per annum by end of this year to further debottleneck the mine along with the ongoing decline development work. The work of new mill of 1.5 million ton per annum and the paste fill plant is on with projected commissioning in a year's time. Finally, we expect to commission fumer at Chanderia very soon now. This plant is a major sustainability and recovery initiative, as you know, which will produce 6.2 KT of zinc and lead metal, 32 ton of silver, and also generation and storage of zero-side. As part of ongoing expansion capacity, we have debottlenecked our smelter to 1.07 million ton per annum. The increase in zinc production capacity has mainly come by cellulose efficiency and roaster throughput. The standalone lead production capacity has been achieved by debottlenecking of ISF smelter and Dariba lead plant. We are further increasing capacity through addition of new cells and improvement in cell house performance in zinc smelters and additional lead refinery capacity at Chanderia, which will increase total metal capacity to 1.13 million ton per annum by Q3 of this year. Now to provide production guidance for FY 2020, as I mentioned earlier, we expect to reach our design capacity of 1.2 million ton per annum by the exit of second quarter this year. We have debottlenecked our smelter to 1.07 million ton per annum and will further increase it to 1.13 million ton per annum also around the same time. We expect both MIC and metal production in FY 20 to be above 1 million ton. This implies metal growth rate of about 12%. Silver production will continue to grow in double digits and expected to be in the range of 750 to 800, which is a natural growth looking at the growth we had last year. Now I will request Swayam to present financial performance.
Thank you, Mr. Duggal, and good afternoon to all. Total revenue from operations during the quarter was marginally lower by 1% sequentially at 5,491 crores due to metal prices and scrap sales offset by lower metal volume and rupee appreciation. Q4 revenue was down 13% from a year ago on account of lower metal prices and zinc volume, partly offset by higher lead and silver volume and rupee depreciation. For the full year, revenues were down by 4% to 21,118 crores as record lead and silver volumes and rupee depreciation were more than offset by lower metal prices and lower zinc volume. Zinc cost of production before royalty declined marginally from previous quarters to 987 in Q4, primarily on account of decline in imported coal prices and also HSC as well as increase in linkage coal. However, the benefit of lower commodity prices were offset by higher mine development expenses and lower volumes. Acid credits were also marginally lower. As compared to a year ago, COP during the quarter was higher by 7% on account of higher mine development, higher employee cost, and also lower volume. COP benefited from higher credits including acid where price rose sharply and for the year, COP increased by 4% to $1,016 primarily on account of higher mine development, steep increase in commodity prices, especially coal and diesel, lower volume, and employee costs partly offset by higher acid credits. COP in rupee was further affected by rupee depreciation. Against our linkage entitlement of over 40%, we received about 20% in the quarter, a significant improvement over single-digit allocation till last quarter. EBITDA for the quarter was marginally lower by 2% sequentially to rupees 2,797 crores, in line with revenue and flat expenses. As compared to a year ago, lower revenue and higher cost of production resulted in EBITDA declining by 23% in Q4 and 13% for the full year. Net profit for the quarter was 2,012 crores, down 9% sequentially and down 20% YOY, and full year net profit was down by 14% to rupees 7,956 crores. Net profit for both the quarters and full year were helped by higher treasury income on account of mark-to-market gains resulting from decline in interest rates, even as corpus was lower on account of payment of special interim dividend in November last year. Depreciation and amortization, on the other hand, has trended up due to higher capitalization and increase underground ore production, resulting in higher amortization. Our gross investments were at 19,490 crore at the end of the quarter, while net investments were 16,953 crore due to temporary borrowings to pay dividends. In comparison, net cash and equivalents were 20,395 crores at the end of FY 2018. Now, looking at outlook, in this year, we will be completing several of our projects, including production shaft at Rampura Gucha and RD, paste fill plants at SK, RD and Jawar, dry tailing plant at Jawar and SK, a fumer at Chanderia, and mill at RD. We expect project capex to be in the range of 350 to 400 million this year. Looking forward, coal cost would improve, supported by better linkage and benign coal prices scenario. A productivity initiative will positively impact COP. We expect rupee to marginally depreciate, while commodities other than coal are anticipated to remain strong, driven by strong domestic consumption demand and global price trends. During this year, we are planning faster mine development to strengthen our assurance of output capability and expect to double our value-add product portfolio, which is 13% current year to 25% next year. Overall, we expect zinc cost of production for full year to further improve and be below $1,000 per ton, with volume growth being offset by accelerated mine development. Cost is expected to improve progressively over the quarters in line with volume ramp-up and project commissioning, including ancillary plants. I would now request our CEO to sum up today's discussion.
Thank you, Swam. For the last 2 quarters reaching production run rate of 1 million ton, we expect to achieve design capacity of 1.2 million ton by middle of this year and touch this run rate by the 4th quarter. We delivered record lead and silver production this year and expect to be in the top 5 in global silver ranking as we ramp up production over the next 2 years. We expect to deliver double-digit growth in metal and silver production in FY 2020. With zinc price holding up with an optimistic outlook, we should deliver record operating and financial performance this year. With this, I open the floor for questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Yeah, thanks. So first question is with respect to the cost guidance, which is around $1,000, very similar to FY19. Now, despite the shaft commissioning in the first half and also lower coal costs because we are expecting linkage coal supply from Coal India and even seaborne prices are a bit lower. The cost guidance looks a bit conservative. If you can just elaborate, what are the cost saving we expect after the shaft commissioning?
So I think you are right that we are a bit conservative on the cost guidance. So the fuel prices are better off now. So we are in a much better position. So, and our base is reset. With the base reset, what I mean is that now this was the first year when we didn't have the open cast, and now from now on, whatever the growth, what we talked that 20%, 30%, 35%, which has come in the MIC will come from the underground mining and the base is there. So that means the volume will be there, the fuel will be better, shafts will get commissioned. One of the June, the hauling will start in SK. The hauling will also start in 3rd quarter in Rampura Gucha. There could be some initial teething troubles here and there, but these are all the advantages of cost. You are right, we are there, and we are also focusing on efficiency going forward, be it pull of the jumbo machines, the fill factors, the cycle time. So all these themes are picked up this year. And but one thing we are trying to do this year is that we want to very aggressively push the development forward. So the development cost could be higher this year. So because we want to set up the mines for the future as it is ramping up. So it's a combination of all these factors, and we said that the cost will be below $1,000. So somewhere below $1,000, it could be in the range of $975 to $1,000. Bit conservative, but it's okay. This time we want to meet our numbers.
Understood. On the volume part, sir, we are guiding for 1 million ton. Now both RA and SK should be commissioned, the underground shaft in 1H. So, I mean, will there be any stoppage or something during commissioning, and how will be 1H versus 2H? Will it be significantly skewed towards 2H?
No, I don't think it's a very even plan. If you ask me, there's not much of the screw between H1 and H2 or quarter-wise. As the shaft will get commissioned, of course, the volume will go up. But you also see that we have touched around 5.3, 5.4 billion ton from SK, and our license capacity is 6 million ton. Rampura Agucha, we have a margin because 3.3 last year. This year we are looking at 4.2, 4.3 million ton. So a lot of uptake will come from the shaft. So it will set us up. And if we take a natural growth, which we have been giving from underground mine, so from a production of 936 KT last year to more than 1 million ton, we have said more than 1 million ton. So I think our numbers will be almost there in the next year.
Understood. So one just last bookkeeping question. If you could share the grade of zinc for FY19 versus FY18? Zinc and lead both.
It is almost same. The overall grade was 7.7, 7.8. And next year also it is going to be almost the same, because the way we have made our business plan, the contribution from all the mines will be such that the grade will remain same. In last year, the grade has fallen by almost 1%.
And if you could break this into zinc and lead?
I would say the overall grade, zinc and lead, the average grade could be 1.6, 1.7% lead, and rest is zinc. But it is normally, if you ask me in the ratio wise, it is 78 to 22% exactly. The contribution of MIC. The grade in the in situ grade could be different, but the contribution from zinc and lead in MIC terms was 78 to 22%, and it is almost going to remain same. It rose up from 15-16% to 22%. So that is why you must have seen that our growth on lead is higher, and that is why the silver is also higher. Of course, there are other silver initiatives like recovery and few other things, but this was the basic contribution.
20 will also be 78-22 approximately, FY20?
Yes. Okay. Overall grade will be same, and the contribution will also be similar.
Got it. Thanks and all the best.
Thank you.
Thank you.
The next question is from the line of Ritesh Shah from Investec Capital. Please go ahead.
Hi, sir. Thanks for the opportunity. So my first question is on the volume guidance that you indicated. I think for RAM, you indicated 4.2 million tons this year. Earlier, I think you indicated target production was 6 million tons for this year. So this 6 million tons, what you indicated, I think you indicated 5 million tons for RAM. Was that the exit rate?
No, the design capacity is 4.5 million ton from Rampura Agucha.
Okay, and sir, what is the target for this year?
4.2.
4.2, and sir, same way for SK and RD?
SK target is 6 million ton, and RD is around 1.3, 1.4 million ton. But we also require the environment clearance. The public hearing has happened. The presentation is happening, and then maybe another 2-3 months we will get the environment clearance for 2 million ton. So in RD mine, also, as you know, the debottlenecking is going on. We are debottlenecking the shaft so that we can produce the better material. So the order we have already placed on ABB for debottlenecking the shaft. And ultimately, we want to produce 2 million ton. And the current capacity of the mill is around 0.91 million ton. And we are setting up the another mill of 1.5 million ton capacity, which we feel we can debottleneck to 2 million ton. But the new mill design is such that it can give us additional recovery of 8 to 10%.
Okay. Sir, my second question is, our key levers, basically, if one looks at Rampura, Agucha, RD and Zawar, they expire by 2030. So, sir, what is our strategy over here? Do we plan to ramp up the output or are we factoring that we'll have the right of first refusal going to 2030? So, how are you looking at the mine life? How are you planning the asset?
No, the right of first refusal is already there. And I don't know how many of you have the information that the Niti Aayog had the very aggressive consultation with the various bodies and very open mind. Even the mines which are not captive, which the license of which will expire in 2020, government is thinking whether to do something about that or not. So 2030 is quite far away. Number one. Number two, the right of first refusal is there. And I think the way the government is thinking to liberate the mining on various aspects, I don't think something will not happen by that time.
Okay. Okay. Sir, is there any scope of moving Gamsberg ore to India? The reason specifically I'm asking is you have higher manganese ore at Gamsberg. Global markets concentrate supply is in quite surplus. So is there a possibility of something of this sort actually happening when the Indian smelters utilize Gamsberg ore by blending it?
So there is a various thinking going on. One is that we do not have extra capacity at Hindustan Zinc to treat Gamsberg ore. So we do not have any intention of doing that because we ourselves are doing our smelter debottlenecking as the MIC capacity is going up. So we do not intend to bring that ore here, but there is a various thinking which is going on. The thought also crossed our mind whether we should put up a smelter in India at the port somewhere in Kakinada or in Gujarat and all that. So a lot of thought goes on, but we also have in our mind that we put up a smelter at Gamsberg itself. So we are in talks with the South African government along. Their president spent complete 1 day at Gamsberg recently, and we are trying to motivate government to enter into some kind of partnership with you where they declare Gamsberg as the special economic zone because 250 KTPA capacity we have set up and we have the intention to double this capacity going forward and parallelly put up the smelter. So the first plan is to put up a smelter there, get some incentives in terms of after putting up a special economic zone, and then maybe some power tariff debate if they can give us. So we are in talks with them, quite advanced, but the first intention and first preference is to put up the smelter at Gamsberg.
Okay. Sir, specifically to what you referred on the recent Gamsberg visit, in the presentation what we look at is the guidance what has been given for 2022 is 1.533 million tons for Hindustan Zinc and Zinc International together. And what we understand for Zinc International, it would be around 500 KT. So then how this number stacks up if one had to break it up between Hindustan Zinc and Zinc International?
So that's a very conservative estimate you might have looked at. So if you look at the present capacity which we have set up at Gamsberg and Hindustan Zinc, so after it matures in a year or so, it will be 1.5 million ton. But we have the intention to double this capacity at Gamsberg in the next 2 years' time by putting up a concentrator and the expanding the mine. This is not a difficult mine, but we have learned now that how to treat that ore at concentrator. And if that capacity 500 comes up and 1.2 here goes to 1.35, so it will be around 1.8, 1.9 million ton, I would say, two together.
Okay, that helps. Sir, just last two questions. Sir, you had indicated in the prior call that we will have a decision on fertilizer plant post-March. So one is any update on that? And secondly, any regulatory update on SK North and SK South, which has been pending since quite some time?
Yeah. So first let me take up fertilizer. The update is that the public hearing has taken place. The file has gone to MOEF. The presentation is going to take place. And after the presentation takes place, we will get the environment clearance, maybe another 3-4 months time. In the meantime, we consulted some experts of fertilizer, the word nod, and we have taken some of them on our board as advisors. So they have, been able to tell us that how we can increase our capacity with the almost same capex from 0.5 to 0.75 million ton. So with that, the IRR goes up and this project becomes more exciting. So we are redesigning that, and at the same time when we get the environment clearance, so two together could become an exciting combination, and then from there we will take on that we start the work on the ground. This is the update here. And second thing you asked on the SK North and SK South, we have been able to establish our rights at both the places. Not that the government has given the clearance, but the revisionary authority in the Mines Ministry decided in our favor and referred it back to the state government for a decision. Not only SK South, SK North, one of the mine in the Bamniyakala also is in the same category. So there are three licenses there. So with the discussion on the saved license, this also comes in the category of saved licenses. There are around 500 saved licenses in India, for which the decision has not been taken by the government. 26 licenses are there of Hindustan Zinc. Some of these licenses, SK North, SK South and Bamniyakala are also there. But there are a large number of licenses. So we told government that, the easiest way to open up the mine, that where the exploration has already been done and the evidence is also there that the ore is there. So the government is quite positive in that. So what we think that as the new government comes, whosoever comes, the Goa mining opening, some of the saved licenses, 2020, maybe the differentiation between the public sector and the government. So some of these things should go. Let us wait and see, but I think things should move in a positive direction. I am quite hopeful.
Sir, just last follow-up. So, sir, can SK North and SK South offset the lease expiries of 2030? Last question, Priti.
Okay.
No, that is a different thing. But I think in SK we have if I remember right, my license is there up to 2045 or something like that. SK I have a license for much longer time, and this has got nothing to do with. It has got nothing to do with the SK North and SK South. RA license is there up to 2030. SK license is there up to 2043, 45, something like that.
Yeah. Perfect. Sir, thank you, sir. Thanks a lot.
Thank you. Participants are requested to limit their questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up. The next question is from the line of Amit Dixit from Edelweiss. Please go ahead.
Yeah, thanks for taking my question, sir. The first question is with respect to the difference in mine metal production and refined metal production. So, mine metal production was 936 KT while refined metal was 894. Did we make any concentrate sales this year or was it due to grades? I just wanted a little bit clarity on that.
So, very good question, I think. Good observation. So, you are right that there is a difference between the MIC production and the finished good was little more in this year. There are 2-3 reasons. Year before, we had a carried over inventory from the previous year to produce the more metal. And this year, there are 2 things which have happened. So, as I said that March was we produced MIC at a run rate of 1.2 million tons. So, 98 KT was MIC and 82, 83 KT was the FD production. So there was an accretion to the inventory which happened at the end of the year, which is carried over to the current year. So this is one reason. Another reason is that we produce zinc oxide in our fumer plant at Dariba and Moorcake treatment plant at Debari. So this zinc oxide inventory also piled up, which we normally use in the ISF furnace, pyro furnace at Chanderia to convert it into zinc. So when the lead inventory built up beyond a point and we did not have the lead capacity and we debottlenecked and retrofitted it for the lead, we converted this into lead and that is why we were able to make a much higher silver also. So this WIP has built up. This also gives us the opportunity. What we are also doing is that we have learned from the world that how they treat zinc oxide. We are putting up a leaching facility both at Chanderia and Dariba, and first at Chanderia, which is about to get commissioned in the month of September or so, where zinc oxide will be leached and we produce the zinc sulfate and push it to the smelters where we convert it into the finished metal. So this zinc sulfate solution will be pushed to the existing hydro plants. So where through the Sellows route we'll be able to convert this. So apart from that, there are other ancillary industries also we are putting up to look at the opportunity of some of the other free metals like cadmium, copper, and other metals which can add value. But this is one such opportunity which will build up over time, as I said, and there will be additional opportunity to convert all these inventories, all these opportunities into the finished good. So especially last year, two things were there. One was the zinc oxide inventory built up. The second is the inventory also built up at the end of the quarter. The first 2 months of January and February were not good because of some safety challenges because of the geotech issues. One of the stope collapsed, and if I may explain, I am just trying to explain a little more. These challenges are going to be mitigated. The similar challenges during the year we also faced in Rampura Gucha, but the commissioning of the paste fill plant, second paste fill plant, we are enough to handle 5 million ton ore or produce 5 million ton ore from Rampura Gucha. So our filling capacity and the voids are not there in the mine. Now as the paste fill plant is getting commissioned in SK mine, the voids will be filled up and these surprises of the geotech will not come. So it will be a more smoother flow of ore and MIC to the smelter as we will mature from now on.
Great, so that was a very elaborate answer. Just a follow-up question on this. So your 1 million ton guidance that you have given for next year, that is excluding this inventory or including this particular inventory benefit?
I'm not going to explain much of the nitty-gritty, but just to correct you that I said plus 1 million ton.
Okay, fair enough. The second question is on cost that was asked by, that's a follow-up that was asked by Sumangal. So, since we are commissioning our shaft in towards H2, and there are a number of other things that are happening in H2, so is it logical to assume that the 1,000 guidance that you have given, there will be a little bit of lumpiness. So H1 would see higher cost, while H2 cost would normalize towards, let us say, 950 kind of levels. Is it a fair assumption?
Yeah, absolutely. You're absolutely right.
Okay, thank you, sir. I have some more questions, but I'll get back in the queue. Thank you.
Thank you. The next question is from the line of Indrajit Agarwal from Goldman Sachs. Please go ahead.
Thank you, sir. I have a couple of questions. First, on the global zinc balance that you see, the TCs that have been negotiated earlier this year have been much higher than the last year, and as a result, we have seen some smelters talking about reopening or expanding capacity. Do you think that tilts the balance more towards higher surplus than what we had expected earlier?
This is all a speculative market, and the basic fundamental which I have always emphasized, and I keep emphasizing that there are no stocks in the exchanges. So this is the better thing to assume. So speculation and the long-term TCs, the people assume certain things. So there is a deficit, I would say, till 2020, which will exist. And we have also seen that some events, we are sitting on the edge, A small event like Australia, it happened. It impacted the LME for 3 months, so it started going up. And similarly, the projects which are in the pipeline have not delivered to the extent they were desired or they talked to deliver.
Sure, that helps. And my second question is on Hindustan Zinc in particular. What is the update on our next phase of growth, like from 1.2 to 1.35 and 1.5 subsequently? How are we looking at it and timelines that you can provide on that?
So, as I explained, we are doing a feasibility study with the global partners. Australian mining company has conducted a pre-feasibility study of what can we do going forward, because there is a descent rate, other safety issues, looking at the ore body, R&R addition. So we still are on the blackboard and planning how this will come up. But there are opportunities around one of the opportunity I would say is that beyond 1.2 definitely is the Bamniagala. Bamniagala lease has been renewed and the drilling is going on. And I expect that we should start developing the mine in the next 1 year time. And 1 year after that, this mine could be operative. When this mine becomes operative, it definitely gives us the opportunity of 50 KT of metal. So similar to this, there are other opportunities we are looking at, and still we have to close our plan, but it will take certainly more time. But this opportunity, what I am talking in Bamniagala, it's already on.
Sure, that helps. Thank you so much.
Thank you. Due to time constraints, we will take the last question from the line of Sanjay Jain from Motilal Oswal Securities. Please go ahead.
Yeah, thanks for taking my question. Just one question. What is the capex we have incurred during this year, and what is the guidance for FY20?
Total capex incurred in FY19 is about 330 million, and the guidance for next year is between 350 to 400 million.
Sorry, I missed the FY20. The voice
350 to 400 million.
Okay. Yeah, thanks.
Thank you very much. I now hand the conference over to Ms. Preeti Dubey for closing comments.
Thank you, everyone. If you have any further questions, please feel free to contact me. Thank you.
Thank you. Ladies
Thanks, everyone.
Thank you, sir.